Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Amazon saved billions under GOP tax law. $1.2 billion. That's the number that jumped out at me from the Wall Street Journal. Amazon's current U.S. corporate income taxes, the accounting measure of taxes incurred, fell to $1.2 billion, down from $9 billion, even as pre-tax U.S. profit rose 44.5% to $89.5 billion. And right there, in one breath, you've got the entire investing game. Not is the business growing, not is the stock up, but how does a giant operator convert growth into durable compounding after-tax cash flows while everyone else is still arguing about headlines? Because the truth is, taxes are not just a cost line. Taxes are a scoreboard for incentives. Taxes are a reflection of what the system rewards. And when the system changes, the businesses that already know how to allocate capital at scale, they don't just adapt, they harvest the new rules. Now, I want to be careful here. This is not a moral lecture. This is a value investor's autopsy, a story about incentives, capital allocation, and the difference between earning and keeping. And the reason it matters is simple. When you find a business that can reinvest enormous sums at attractive returns, and the tax code lets them pull forward deductions, you're not just watching earnings, you're watching the compounding engine get lubricated. So let's walk through what this article is really saying. Not what it sounds like, what it actually is. It's saying the tax code changed, and Amazon, because of what it already is, got paid for being Amazon. And that's the pattern. The pattern is, the largest, most disciplined allocators tend to benefit first, because they have the scale to deploy the incentives immediately. They don't need time to get ready. They're already spending. They're already building. They're already depreciating. They're already pushing R&D. So when the rules shift toward immediate deductions, the compounding accelerates. And it does it quietly. No parade, just numbers. Now let's name the central figure in the story, because it's easy to think the central figure is Amazon, or Congress, or the GOP tax law. But the central figure, in my mind, is the allocator, the decision maker inside Amazon who lives at the intersection of three constraints. 1. Invest aggressively in physical and digital infrastructure. 2. Keep the machine efficient enough to survive the inevitable down cycles. 3. Shape reported results, cash taxes, and timing in a way that preserves optionality. That allocator could be a committee. It could be the CFO. It could be the leadership team. The article doesn't need to name them because the behavior is obvious. The behavior is spend huge amounts, qualify for deductions, protect cash. And when you're Amazon, huge amounts is not a metaphor. The company said it spent $340 billion in the U.S. last year, including operating costs and capital investments. $340 billion. Let that land. Most companies don't even have a market cap that large. Amazon calls it a year of spending. And here's where it gets interesting for us. As value investors, because spending is not inherently good. Growth is not inherently value. What matters is the return on incremental invested capital over time. But the tax code doesn't measure that directly. The tax code measures categories. It measures whether the investment is eligible. It measures whether deductions can be accelerated. It measures timing, and timing is everything when you compound. This is the inflection point the article is pointing at. The new law, signed by President Trump, made two major changes that quickly helped Amazon and other corporations. First, it allowed companies to claim immediate deductions for certain capital investments rather than spreading those write-offs over several years. Second, it reversed a prior rule that forced companies to spread out deductions for research starting in 2000-2002. The new law permits immediate deductions for new domestic research and lets companies accelerate previously delayed deductions. So what's the strategy implication? If you're a capital-intensive company building data centers, like Amazon, you've just been told by the system, build faster, and we will let you deduct more now, not later. Now. And if you're doing real R&D domestically, same idea. Now, I'm going to slow down and do the decision autopsy, because this is where people get sloppy. The article gives us three different tax concepts, and if you don't separate them, you'll misunderstand the entire story. 1. Current U.S. taxes. the accounting measure of taxes incurred. That's the $1.2 billion figure. 2. Cash basis federal income taxes paid. That's $2.8 billion last year, after paying more than $7 billion in each of the prior 2 years. 3. The global effective tax rate. That actually rose to 19.6% from 13.5%. So you could look at this and say, wait, how did taxes go down but also go up? That's the point. Accounting is a language, and the language distinguishes between timing and total burden, between current and deferred, between U.S. and global. Amazon's filing recorded $11.1 billion in deferred U.S. taxes, along with its $1.2 billion in current taxes. Deferred. That word is doing a lot of work. Deferred doesn't mean gone. Deferred means not yet. It means you shift the tax payment into the future by accelerating deductions into the present. And the company basically says exactly that in its own words. Deducting costs more quickly provides a short-run benefit, but it doesn't change the amount of tax paid. It changes the timing. Timing. Again. Timing is oxygen for a compounding machine. And if you can build moats today, you can defend pricing power tomorrow. That's how the game is played at scale. Now, let's connect this to capital allocation, because the article gives you a huge clue about where this goes next. Amazon said it expects to make capital expenditures of $200 billion in 2026, accelerating spending in artificial intelligence projects. $200 billion in CapEx. And at the same time, the company is cutting costs, laying off another 16,000 employees, and closing underperforming businesses. That combination is not a contradiction. It's the signature of a ruthless allocator. Cut what doesn't scale. Fund what compounds. That's the playbook. And I want you to hear the incentives embedded in the law. The first change, immediate deductions for certain capital investments, is described in the article as having the greatest bang for the buck because it accelerates investment. In other words, the policy is designed to pull forward spending. And Amazon, already investing heavily in data centers, has equipment inside those data centers that would qualify. So the question for us is not, is Amazon saving taxes? Of course they're saving near-term cash taxes. The deeper question is, what does this do to competitive dynamics? Because if you're a smaller competitor trying to match Amazon's infrastructure build-out, you have two problems. You might not have the same access to cheap capital, and you might not have the same ability to front-load spending at scale, so a policy that rewards immediate expensing disproportionately benefits the businesses that can spend the most, the fastest, in the eligible categories. The rich get to reinvest sooner, and in business, reinvestment speed becomes advantage. Now, the article doesn't stop with Amazon. It tells you this is broad. So this is a theme. Large, profitable, investment-heavy companies, especially tech, are seeing the immediate benefit, and Amazon didn't just stumble into it. The article says Amazon lobbied on the tax bill and was involved in pushing for changes to the research deduction. Again, incentives. Founders and operators learn quickly that policy is part of the operating environment. If you are a scale business, you don't just respond to the environment, you shape it. Now let's deal with the on-screen evidence, because the visuals matter here. On screen, you're looking at a consumer sentiment line chart from the University of Michigan. You can see the sentiment index sliding and then stabilizing, and the latest labeled point is February at 57.3. The article says sentiment ticked up to 57.3 from 56.4, and analysts expected 55. So it beat expectations, but it's still low enough that the director of the survey, Joanne Shu, is basically telling you, don't get carried away. Concerns remain widespread. Erosion of personal finances from high prices, and an elevated risk of job loss. And there's another detail in the article that matters more than the headline. Consumers' expectations for inflation over the next year declined, but longer-run inflation expectations ticked up slightly, and the article notes that Federal Reserve policymakers are especially intent on keeping longer-run inflation expectations in check. So why is this sitting on the same page as Amazon's tax story? Because this is the macro backdrop that shapes the discount rate, the wage environment, the political response, and the market mood. When sentiment is weak, politicians reach for levers. Tax refunds go up, corporate incentives shift, and the biggest companies, the best allocators, translate that environment into advantage. Now, the other big on-screen visual is about the Dow. On screen, You're looking at a chart labeled Dow Jones Industrial Average, trading days between 10,000 point milestones. And the numbers are almost comical when you say them out loud. It took 28,313 trading days to reach 10,000, then 4,486 days to reach 20,000, then 874 days to reach 40,000, then 431 days to reach 50,000. This is not just a market trivia chart. It's a psychology chart. It's showing you acceleration. It's showing you the compression of time. And when time compresses in markets, people start to believe the recent pace is normal. They start to extrapolate. They stop thinking in cycles. They start thinking in straight lines. The article around that visual talks about a Dow rally of over 1,200 points in a day, about 2.5%, with the S&P 500 up 2% and the Nasdaq up 2.2%. It talks about buying the dip being treated as a safe bet in recent years. It talks about a reacceleration theme, and it ties it to rotation into banks, industrial firms, and other sectors more linked to the real economy. And it also gives you the warnings: price pressures squeezing lower, and middle-income people, sluggish hiring, and even Fed Chair Jerome Powell cautioning that official figures might be overstating labor market strength. So you have this strange cocktail: markets ripping higher, sentiment barely off the floor, inflation anxiety still present, a giant company paying much less in current taxes while investing at enormous scale. That's not random. That's a snapshot of a system where asset prices can detach from household mood while corporate cash flows benefit from policy incentives. Now, there's another on-screen element you may be seeing: a photo of a trader watching as the Dow surpassed 50,000. The photo matters because it captures the emotional center of markets, a human being staring at a screen as a round number breaks. Round numbers are not fundamentals, but they drive behavior. They trigger stories. They invite leverage, and those stories influence capital allocation decisions in the real economy. Because when markets feel strong, the cost of capital feels lower even if rates aren't. Now, let's bring it back to Amazon, because that's the spine of our episode. Amazon's U.S. pre-tax profit was $89.5 billion. Its current U.S. taxes were $1.2 billion. Its cash federal income taxes paid were $2.8 billion. And it recorded $11.1 billion in deferred U.S. taxes. So the reality check is this: the tax benefit is real, in timing. But the obligation doesn't disappear. And Amazon itself says the policy doesn't change the amount of tax paid, just the timing. So what should a value investor do with this? You should ask, what does Amazon do with the timing benefit? Do they reinvest at high returns? Do they use the cash to build durable advantages? Or do they burn it on low-return projects because capital is abundant? The article gives you a clue. They're pushing hard into AI, expecting $200 billion of capex in 2026, while also cutting costs and shutting underperformers. That suggests discipline, not perfection. And this is where business quality shows up. A high-quality business can do two things at once. It can invest aggressively, and it can prune aggressively. Low-quality businesses can't. They invest because they have to, and they cut because they're forced to. High-quality businesses invest because they see opportunity, and they cut because they respect opportunity cost. Now, the political and reputational layer matters too, and the article touches it. Amazon has, at times over the past decade, reported little or no current U.S. taxes, while reporting large profits, a pattern that drew attention in Congress. And in 2022, under President Joe Biden, lawmakers created a corporate minimum tax aimed at ensuring companies pay at least 15%. But the article notes that law retained incentives for capital investment. And while companies like Meta have warned they're getting hit by that tax, Amazon's filing doesn't suggest much effect. In other words, even the minimum tax regime still bends toward investment. That's the incentive. Build, spend, invest, employ capital. And if you're Amazon, that's what you are going to do anyway. So the system ends up reinforcing the dominant strategy of the dominant players. Now, I want to touch briefly on two smaller items on the page, because they're signals, and value investing is about pattern recognition. One, the FDA is referring hims and hers to the Justice Department for potential violations of the Federal Food, Drug, and Cosmetic Act tied to compounded versions of GLP-1 drugs that aren't approved by the FDA. That's regulatory risk becoming real. That's a reminder that growth built on gray zones can be interrupted overnight. 2. A missing person case involving Nancy Guthrie, with law enforcement reviewing a new message for authenticity. Different topic entirely, but it's still about uncertainty and information. Markets, regulation, investigations, they all live in a world where facts arrive imperfectly and people act anyway. The best operators build systems that survive that fog. Now, let's extract the lessons. Lesson 1. Incentives shape outcomes more than intentions. If the tax code rewards immediate expensing, the biggest spenders will spend more sooner, and they will look more profitable after tax in the near term, even if the long-term tax burden is mostly shifted forward or backward in time. Lesson 2. Scale turns policy into a moat. The same rule change can be nice for a small company and transformational for a giant, because the giant can deploy it immediately across hundreds of billions of dollars of eligible investment. Lesson 3. Most failures come from success carried too far. When the market hits milestones faster and faster, like those 10,000 point steps compressing from tens of thousands of days to a few hundred, the temptation is to believe risk has been abolished. But the article itself flags warning lights: inflation pressure, sluggish hiring, doubts about labor market strength, and AI-driven volatility that can reshuffle the hierarchy. So here's the core question this page is raising, whether it admits it or not. In a world where policy rewards investment, where markets celebrate milestones, and where consumers still feel squeezed, who actually compounds? And the answer, over and over, is the businesses that can allocate capital at scale, under real constraints, with the discipline to cut what doesn't work and double down on what does. Amazon is not just selling products. It is building infrastructure. It is shaping timing. It is converting today's incentives into tomorrow's optionality. And if you're a value investor, you don't look away from that because it's messy or political or complicated. You lean in because that's where the compounding hides. I'll end with one sentence I want you to remember for years. When a system rewards reinvestment, the best allocators don't just earn more, they get to earn sooner. And sooner is where compounding begins. Moving to next title, DOJ looks at Netflix's practices. 30%. That's the number that makes this whole thing combustible. Not because it's a magical number in economics, but because it's a number that regulators, lawyers, and executives all recognize as a line in the sand. And today, in the Wall Street Journal, that line shows up in the middle of a very modern ambition. Netflix trying to combine with Warner Bros.' HBO Max streaming service, while the Justice Department looks closely not just at the deal, but at Netflix's practices. This matters for one reason that serious investors sometimes forget. In the long run, business quality compounds, but in the medium run, the rules of the game can interrupt compounding. And antitrust is one of the few forces that can reach into a company with world-class execution and say, you can't do that. Not like that. Not now. So I'm going to treat this like what it really is. A capital allocation story, a market structure story, an incentive story. And, if you're willing to think clearly about it, a story about how a distributor becomes so important that the government starts asking questions that sound like philosophy, but are actually about power. Because Netflix isn't just buying assets here. Netflix is attempting to change what it is. And when a company tries to change its category, the world responds. Competitors respond, customers respond, and regulators respond. Let's name the central figures because this doesn't make sense unless you know who is actually driving the plot. The first central figure is Netflix itself. Specifically, the people inside Netflix who decide how to allocate capital, how to frame competition, and how to defend the company's freedom of action. That includes Ted Sarandos, Netflix's co-CEO, who has been out in public saying consumers would pay less for a bundled Netflix and HBO Max. The second central figure is the Justice Department, the enforcer that doesn't just look at spreadsheets, but looks at the structure of a market and asks whether the structure is getting too concentrated, too dependent, too one-sided. And the third central figure is the rival bidder, Paramount, which is also in the mix and pitching an all-cash offer for all of Warner, arguing its path is more certain and faster to completion. So you've got three sets of incentives colliding. Netflix wants a bigger content engine and a tighter grip on the living room. Paramount wants to win Warner outright with cash and certainty. The Justice Department wants to know whether either outcome reduces competition in a way that hurts consumers, creators, or the market's future. Now let's talk about the inflection point. For a long time, Netflix's dominant story was straightforward. They were a subscription product. They were a recommendation engine. They were a distribution platform that made content. Yes, but they weren't the studio system in the old sense. They didn't look like the legacy conglomerates. They looked like software. And for a long time, that framing helped. But what quietly changes when Netflix tries to combine with Warner's HBO Max? The company stops being just the best distributor and starts looking like a distributor that is also absorbing a major supplier. That shift triggers a very specific set of questions. Not the fluffy questions, the legal questions, the ones that can stop a deal. The Justice Department's investigation is described as early stage, and that's important. Early stage doesn't mean harmless. Early stage means the government is still deciding what theory of harm it wants to pursue, because in antitrust, the facts don't matter until they fit into a theory. And that's why the subpoena matters. The department asked whether either deal might hurt competition. It asked how past mergers of studios or distributors affected competition for creative talent. And it asked for information about how talent contracts vary between studios. That is a very revealing line of inquiry, because it says the government is not only thinking about subscription prices and consumer bundles, it's thinking about the labor market for creativity. It's thinking about the bargaining table. It's thinking about whether a combined entity can set terms that ripple through Hollywood and through every production contract that matters. Now, I want to slow down and make the numbers concrete, because this is where the debate gets distorted. We have 3 numbers, and each one is a weapon depending on who is speaking. Number 1. Around 30% of the U.S. subscription streaming marketplace. That's the estimate for Netflix and HBO Max together, based on antenna estimates, and it explicitly excludes bundles with wireless or cable providers. And notice what happens immediately after that number appears. Netflix says the statistic isn't meaningful because about 80% of HBO Max subscribers also subscribe to Netflix. That's number 2, 80%. This is Netflix saying, look, we're not taking 2 separate customer bases and combining them into one new overlord. We're largely combining overlapping households. So they argue, concentration is overstated. Then comes number 3, 10%. Netflix says the combination would be only about 10% of viewing time in US TV households. Now that's a fascinating choice of metric, because viewing time shifts the conversation away from subscription counts and into attention. It pulls YouTube and other free platforms on TV into the competitive frame. And that's exactly what Netflix wants. Netflix wants to say, the market isn't paid subscription streaming. The market is everything you can watch on the biggest screen in the house, including free video platforms. Because when you define the market broadly, your share looks smaller. And when your share looks smaller, the deal looks less threatening. Now, here's the key line that makes this more than a PR argument. Mergers of direct competitors are presumed to be illegal when the combined company would have more than 30% market share, according to Justice Department guidelines. That's why 30% is the match that lights the room. But there's another number in the article, and I want to highlight it because it's the implicit threat behind the whole process. U.S. law says monopolies generally involve much higher market share, 60% or more. So you can hear the two sides talking past each other. Netflix wants to live in a world where the relevant number is 10% of viewing time, in a broad market with YouTube. Regulators can live in a world where 30% in a narrower category is already enough to presume the deal is illegal as a merger of direct competitors. And in the background is the word monopoly, which carries the 60% framing. Now, the company's strategic posture depends on which label the deal gets. Netflix argues it doesn't directly compete with Warner Bros., and that the deal should be regarded as a vertical merger. In their framing, Netflix is mainly a distributor for content, and Warner is a supplier of movies and TV shows. Vertical mergers are often treated differently than horizontal ones because the classic fear of a horizontal merger is simple: fewer competitors, more pricing power. But vertical mergers raise a different fear: control over distribution that can hobble rivals upstream or downstream. And here's the crucial line in the article that tells you what the Justice Department might be thinking. Scrutinizing whether Netflix has unfairly hobbled rivals could give the department another legal argument against the acquisition. Another argument. That's the phrase to underline, because it suggests the government might not limit itself to the pure market share fight. It could go hunting for behavior, for practices, for conduct that can be painted as exclusionary. And once you move from pure merger math into conduct, the case becomes less about percentages and more about narratives: who harmed whom, how, and whether it will get worse. Now, I want to bring in the precedent the article mentions, because it tells you how regulators sometimes build their playbook. The Justice Department's prior investigation of Visa's proposed acquisition of Plaid is held up as a reference point. Back then, the department looked at Visa's market power, cited a 70% share in online debit transactions, and sued to block the deal. Visa abandoned the transaction, and then years later the department sued Visa again, alleging it monopolized debit markets. Why does that matter for Netflix? Because it shows something very uncomfortable for dealmakers. Even if you escape a deal fight, or even if you walk away, the scrutiny can continue. Regulators can treat a merger review as a window into your business, a way to learn how you operate, a way to collect information, map the market, and decide what else they might pursue. The article also notes a specific individual who ties the precedent to the current situation: Mahkan Delrahim. He's Paramount's chief legal officer, and he previously served as the Justice Department's antitrust chief during President Trump's first term, including the decision to challenge the Visa Plaid deal. And Delrahim, as part of his pitch for Paramount's offer, has suggested the department could follow the Visa playbook in its investigation of Netflix's acquisition. So, again, incentives. Paramount wants to win Warner. One way to win is to make your own offer look cleaner. Another way to win is to make the rival's path look risky. Regulatory risk becomes a competitive tool, not always explicitly, but functionally. Now let's talk about time, because time is where compounding lives, and where deals go to die. The article says merger reviews can take as long as a year, though sometimes they move faster. A year is not just a calendar fact. A year is an operating cost. A year is uncertainty for employees, creators, and partners. A year means you're running a company while also preparing for a courtroom. And if you're Netflix, a year means your competitors aren't waiting. They're shipping product. They're bidding for talent. They're bundling their training consumers to live without you owning HBO Max. So the longer this stretches, the more the opportunity cost matters. That's why expedited path to completion becomes a selling point for Paramount's all-cash pitch. Certainty is a form of value, especially when you're buying something in a market that evolves monthly. Now, Netflix and Warner have said they expect regulatory approval. And I want to hold that sentence up, because it's an extremely common pattern in corporate life. Executives speak in the language of intention and optimism. Regulators move in the language of discretion and deterrence. Both sides can be rational, but only one side has veto power. Now, let's bring in the political layer, not because politics is the point, but because it affects incentives. The article says President Trump indicated in an interview that he wouldn't get involved, and that it was up to the Justice Department. That's a signal, at least publicly, that the enforcement process will run through the institutional channel rather than becoming a direct presidential negotiation. And for a company trying to close a deal, that means you can't assume you'll talk your way out at the top. You have to fight the argument where it lives, inside the antitrust process. Now, I want to explicitly align this with what you're seeing on screen in the podcast video. On screen, you're looking at an image tied to Netflix, something that visually screams brand and distribution. A big, unmistakable Netflix mark. It's not subtle. And that's the point. This isn't a small company doing a small deal. This is the dominant consumer streaming brand trying to absorb a major legacy studio and streaming asset. The visual is evidence of scale. Scale is what triggers scrutiny. Now, there's also a caption that matters. Netflix and Warner saying they expect regulatory approval. That one sentence captures the tension between corporate confidence and regulatory uncertainty. And if you're listening and you're also an investor, you should train yourself to do something here. Whenever you hear, "we expect approval," translate it into the real question. What is the enforcement incentive to say no? Because regulators don't get rewarded for being passive when concentration grows. They get rewarded for looking tough. They get rewarded for deterrence. They get rewarded for preventing the deal that later looks obvious in hindsight. And that's why so many deal outcomes are shaped not just by economics, but by the career incentives of the people who have to sign off. Now let's do the capital allocation/decision autopsy. Netflix's decision, in spirit, is buy assets that deepen content, widen the moat, and create bundling power. The expected outcome: stronger retention, higher lifetime value, better leverage over distribution economics, and a bundle that can plausibly be sold as cheaper for consumers, as Sarandos testified. What actually happens in the world? The government asks whether the market becomes less competitive, whether talent faces fewer buyers, and whether the combined company can hobble rivals. And the opportunity cost is massive. Because while Netflix is pursuing this, it's also living in a market where free video platforms compete for viewing time and where competitors are constantly looking for their own bundling advantages. Hidden trade-offs? Here's one. When you become big enough that your deal is presumed illegal based on a threshold, your strategy stops being purely operational. It becomes partially legal, partially political, partially about how you define the market, which is a weird thing to say out loud. But it's true. And another hidden trade-off is reputational. A company that wins by being loved by consumers can find itself being described as too powerful by enforcers. That changes how partners behave. It changes how rivals coordinate. It changes what you can do quietly. And in investing, most failures come from success carried too far. Success makes you confident. Confidence makes you reach. Reaching triggers the world's antibodies. Antitrust is one of those antibodies. Now, let's talk about the part that is called DOJ looks at Netflix's practices. Because that phrase is doing more work than it seems. A merger review is one thing. A practices review is another. A merger review asks, if this happens, what changes? A practices review asks, what are you already doing and is it fair? That shift is dangerous for any dominant distributor. Because if the government convinces itself that you've been hobbing rivals unfairly, it gains a broader window into how you do business. The article says the line of questioning could give the department exactly that, a broader window. And if you're Netflix, the best case story is, this is a standard review. A Netflix lawyer, Stephen Sunshine, says the company believes the department is conducting a standard review of the proposal to buy Warner's studio and streaming assets, and that Netflix has not been given notice or seen other signs of a separate monopolization investigation. Netflix also says it is constructively engaging with the department as part of that standard review, and remains focused on the value. That is the official posture. The calm posture, the posture of a company that knows panic is expensive. But as investors, we're not paid to repeat posture. We're paid to think through incentives and second-order effects. So here's the reality check. The Justice Department is doing what it is supposed to do. Test the deal, test the market definition, test the competitive effects, and test whether conduct offers another route to challenge. Paramount is doing what it is supposed to do. Present itself as the more certain outcome for investors, and, through experienced legal framing, remind everyone that regulators can and do block deals. Netflix is doing what it is supposed to do. Broaden the market definition, emphasize overlap, emphasize viewing time, and emphasize consumer savings through bundling. And Warner, caught between offers and outcomes, is living in the land where headline value and closing certainty don't always match. Now, 3 lessons, timeless ones, for anyone serious about value investing and long-term compounding. Lesson 1. In markets with gatekeepers, power becomes a liability as well as an asset. The bigger the distribution platform, the more it attracts scrutiny, and that scrutiny can slow the very compounding you're trying to accelerate. Lesson 2. Market definition is a strategic asset. Netflix's choice to talk about viewing time, and YouTube isn't just rhetoric. It's a way to reshape the battlefield so that the numbers look different. Investors should watch that carefully, because the company that can credibly redefine the market often retains freedom of action longer. Lesson 3. Regulatory time is a real cost of capital. A year-long review isn't just delay, it's optionality lost, attention diverted, and a competitive landscape that moves while you're frozen in process. So what's the core question this article raises? It's not, will the deal be approved? That's the surface question. The deeper question is, can Netflix continue to compound its advantages while it becomes large enough that every major move is treated as a public event, a legal event, and a structural event for the entire industry? And my answer, my conviction, is that great businesses still compound under scrutiny, but they have to evolve. They have to learn how to allocate not only money, but also political capital, legal risk, and strategic framing. They have to learn how to stay aggressive without becoming careless. Because when you become the default choice for consumers, you also become the default target for regulators. I'll end with one sentence I want you to keep in your head the next time you see a giant company announce a giant deal. In the long run, execution compounds, but in the short run, permission is a moat you don't control. Moving to next title, here's where AI is tearing through corporate America. It's the questions. A brand company employee walking into the office of the chief digital officer and asking, with real urgency, should we start using this new AI tool to review legal documents? That's the tell. That's what the Wall Street Journal is capturing in this piece. The moment AI stops being a side project and starts becoming the default interface for work. And when that happens, the old software stack, the one that took decades to build, billions to sell, and entire careers to manage, suddenly looks optional, not worthless. Optional. That is a brutal word in business. Optional means your pricing power is on trial. Optional means switching costs can collapse. Optional means the buyer stops renewing out of habit and starts renegotiating out of confidence. So let's walk through what's actually happening here, using the article as our only source of truth and looking at it the way value investors should, through incentives, capital allocation, and the compounding consequences of a small tool that quietly changes behavior. The story opens inside Authentic Brands Group, not a Silicon Valley lab, a real operator, a company with about 600 employees that owns brands including Reebok and Champion. And their people are hunting down the chief digital officer, Adam Cronengold, because something just changed in the market. A new plugin from Anthropic exists. They're asking if they should use it to review legal documents. Let's pause on why that question matters. A legal review workflow is not a toy problem. It's high stakes, slow, expensive, and reputation sensitive. It's exactly the kind of work that created categories of specialized enterprise software. And now, a general AI assistant, Anthropic's Claude Cowork, is being positioned as something that can do tasks on your computer through natural language prompts, by letting users assign agents to perform many types of tasks. Not help me write an email, not summarize this. Agents performing tasks, workflows automated, job functions touched end to end. And this is why markets reacted the way they did. Because when investors smell a shift from software is the tool to AI is the operator, they immediately reprice every company whose product is a narrow workflow. That's not cruelty. That's discount rates doing their job. If future cash flows become less certain, valuations change fast. The article says the immediate catalyst for the week's sell-off was the release of new capabilities for Claude Cowork. These tools can automate workflows and perform tasks across a gamut of job functions with little human input. And the plugins released about a week ago can review legal contracts and perform other industry-specific functions. Then a model update enhanced capabilities for financial analysis. Legal contracts, those are two of the most defensible territories in enterprise software because they're tied to trust, compliance, and consequences. When AI walks into those rooms, the market hears boots on the hallway floor. And you see it in the numbers. The article says stocks of major software firms, Salesforce, Intuit, ServiceNow, dropped 10% or more in recent days. And it calls this an abrupt acceleration of a trend that has been playing out for months, with the closely watched IGV software index down around 30% from its late September peak. 30%. That's not a dip, that's a repricing. And the narrative investors latched onto is described bluntly. A doomsday scenario for the $1.2 trillion software industry. The scenario is that companies will be able to vibe code their own tools, generate code by plugging natural language prompts into AI, and cancel software subscriptions. Now, I want to be very precise here, because this is where investors get lazy. The question isn't, will software die? The question is, where does value migrate when the interface changes? Because in every major computing shift, mainframes to PCs, PCs to the internet to mobile, the winners were the businesses that controlled the new interface, or owned the scarce distribution, or captured the network effect that made switching painful. This article is describing a potential interface shift, from clicking through enterprise apps to delegating tasks to an agent with a prompt. And if that becomes normal, then what software means changes. The buyer stops shopping for features. The buyer starts shopping for outcomes. And if outcomes become commoditized, if many agents can produce good enough outcomes, then the economic surplus shifts away from the old vendors. It shifts to whoever owns the agent, the workflow graph, the identity layer, and the billing relationship. Now let's talk about the central figure again, because the article gives us a perfect archetype. Adam Cronengold, the Chief Digital Officer. In a world like this, the CDO becomes something else, not a technology evangelist. A capital allocator, an internal portfolio manager of experiments. He has told employees he'll make sure they get access to the new plugin, but they can keep using the existing software for now. Read that sentence like an investor. It's a hedged position. It's optionality. It's not rip and replace. It's not ignore. It's get access, test it, but don't break the current machine. And that's exactly how good operators behave under uncertainty. They buy options. They don't place one giant bet when the ground is moving. But here's the part that should make you uncomfortable if you own enterprise software stocks. The article says, envision versions of this discussion playing out across corporate America. That's the contagion, not the tool itself. The conversation, once every team has permission to ask, can the agent do this instead? You've changed the internal buying process. And procurement, the quiet gatekeeper of enterprise software, starts getting pressure from the bottom up, not the CIO pushing down, employees pulling sideways. That's a different force. That's how categories get unbundled. Now let's align with what's on screen, because the visuals here are evidence. On screen, you're looking at a chart showing index and fund performance over the past 3 months, with the S&P 500 and the iShares Expanded Tech Software Sector ETF. The software ETF line moves down sharply, down toward roughly negative 30% over that short window, while the S&P 500 is much closer to flat. What is it measuring? It's measuring relative pain. It's measuring where the market is choosing to punish. And what most people miss is that this isn't only about earnings next quarter. It's about fear of permanence. Markets forgive temporary problems. They don't forgive a business model that looks structurally weaker. That's why the move is violent. Now, on the same page, you're also seeing a different set of visuals about boring stocks and low volatility funds. And this matters because capital always needs somewhere to go. When money leaves high beta growth narratives, it doesn't evaporate. It rotates. The article gives numbers that tell you exactly how investors are seeking solid ground. It mentions that in 2025, some exciting stocks had massive gains. Robinhood up 204%, Palantir up 135%, AppLovin up 108%, and then in 2026, they're down 36%, 27%, and 44% respectively. And it points out that the State Street Consumer Staples Select Sector, SPDR, is up 12%, and that Walmart's market cap surpassed $1 trillion. It also notes low-vol funds like Invesco and P500 low volatility up nearly 5%, and iShares MSCI USA Min Vol Factor up almost 1%, both ahead of the S&P 500, which is down nearly 1% for the year so far. So on screen, as the viewer, you're seeing a market making a statement. Give me cash flows I can trust. Give me businesses that don't need the future to be perfect. And the reason those two articles sit together is not an editorial accident. AI shocks the perceived durability of software subscriptions. Investors respond by paying up for perceived durability elsewhere. That's the incentive loop. Fear compresses time, and time compression breaks stories. Now, reality check. This doomsday scenario language is powerful, but it's also a trap if you take it literally. Because disruption doesn't eliminate all incumbents, it reshuffles the hierarchy. The article's core evidence is that the new Anthropic capabilities, agents via natural language, plugins for legal contracts, improved financial analysis, were enough to trigger a sharp sell-off across software stocks. That means the market believes the bargaining power has shifted toward buyers, at least at the margin. But as investors, we should ask the harder question: where will the economics settle? Will enterprises actually cancel? Or will they add AI on top and keep the old systems, because compliance, audit trails, and integration are sticky? The article doesn't answer that fully here, but it gives you a clue in Cronengold's stance. Access to the new plugin, keep existing software for now. That's what adoption looks like early, not revolution overnight. It's parallel systems, it's experimentation, and then, slowly, budgets move. Now let's extract lessons that compound. Lesson 1. The interface is destiny. If the interface to work becomes a conversational agent that can execute tasks, the old category boundaries in software start to dissolve. and pricing power migrates toward whoever controls that interface. Lesson 2. Great operators buy options before they place bets. Kroningold's posture, enable access, keep the existing system, shows how real companies manage uncertainty without freezing. Lesson 3. Markets reprice narratives faster than businesses retool. Software stocks can drop 10% in days, and an index can be down around 30% from a peak, while the actual enterprise budgets and workflows take quarters and years to change. That gap between price and reality is where opportunity can exist, if you understand what is truly becoming weaker and what is merely being feared. And now the ending, with conviction. The question raised by this article isn't, is AI coming for software? That's already true in some form. The real question is, which businesses will keep their right to compound when the buyer realizes they can prompt their way around yesterday's tools? And the sentence I want you to remember is this. When your customer learns they can replace your workflow with a sentence, your moat isn't your features anymore. It's your integration, your trust, and your distribution. Moving to next title, a business that lost money for decades fuels Corning's success today. It took Corning nearly half a century to produce its first billion miles of optical fiber. The second billion took 8 years. And the next billion, the article tells us, will arrive much sooner. That is compounding in physical form. Not an abstract spreadsheet, not a venture capital story. Glass, factories, engineers. Patience. And then, suddenly, demand so strong that you can feel the bottleneck in the economy. This is the Wall Street Journal telling a story that value investors should love, because it's about the hardest thing to do in markets. Lose money on a new idea for a long time, keep investing anyway, and survive long enough for the world to finally need what you built. Everyone told Corning to sell its unprofitable fiber optic business. It lost money on fiber optic cables for nearly 20 years, and now that division is powering its stock to all-time highs. That is not luck, that is a specific kind of corporate character. A willingness to fund learning. A willingness to carry the cost of being early. A willingness to hold an asset that doesn't pay you back on Wall Street's timetable. So let's talk about the central figure here, because in stories like this, the people matter. Wendell Weeks has been Corning's chief executive since 2005, and he came from the fiber optic division. That matters because builders who've lived inside the messy unit often make different decisions than portfolio managers who only see segments on a slide. Weeks isn't just a CEO in this story. He's a translator between physics and capital allocation, between what's possible in a lab and what's profitable in a factory. And alongside him, you've got Mike O'Day, who heads Corning's fiber business, and Claudio Mazzali, Corning's head of research, who says the company outsources almost nothing and even designs the machines used to manufacture its optical fiber and cable. That sentence is the moat. Designing the machines that make the product is a level deeper than we manufacture. It's saying, we own the process, we own the know-how, we own the feedback loop. And when the market turns, we don't need permission from suppliers to scale. Now, the inflection point. Why is Corning suddenly in demand? Physics. Data can be sent far more quickly and with less energy using light photons than using electricity, electrons. The article makes it vivid with a number. Over even short distances, transmitting data with photons is 3 times as efficient as electrons, and Weeks says over long distances, it's more like 20 times. That's not a marketing claim. That's an energy and throughput claim. And in a world that's building AI data centers like factories build engines, energy efficiency becomes a competitive weapon. So Corning's cables, which often contain dozens or hundreds of flexible, ultra-thin glass fibers carrying signals, become the connectors of choice in the global race to build computing power for an AI-driven future. That's the macro wave. Now let's do the decision autopsy. Because Corning didn't just benefit from AI. They placed bets. They made choices. The article gives us a pivotal moment. In 2018, Weeks and O'Day went to Dallas to tour a data center owned by Meta, then known as Facebook. They saw the demand for fiber optic cabling inside that giant warehouse of servers. Meta was using a mix of copper cables and existing fiber optics, but found both ill-suited to the task. So Corning's engineers responded by making cables thinner but also tougher so they could withstand tight bends. That's not a software patch. That's material science meeting real-world constraints: density, heat, routing, installation. Then 5 years later, ChatGPT debuts, and demand for fiber-powered data centers explodes. O'Day says they're thankful they made the trip in 2018, and thankful they made the bet, and he admits they had no idea at the time whether it would be a great investment or a dud. That is the honest voice of a real allocator. You don't know. You place bets anyway. You build capabilities that keep the option alive. And when the world turns, you're standing there with inventory and expertise instead of excuses. Now we get to what the article calls the Corning way. And this is where the story stops being about fiber and starts being about culture as an economic asset. Corning outsources almost nothing. It designs the machines used to manufacture its optical fiber and cable. Self-containment is not just about supply chain. It's about learning speed. It's about protecting tacit knowledge. And it extends to the workforce. When Corning shifts direction, it reassigns engineers rather than laying them off, so they accumulate expertise over decades across different projects. Weeks says the things their engineers do can't be learned from a textbook. That's the kind of sentence Wall Street nods at and then forgets. But that sentence is the balance sheet you can't see. It's the intangible asset that doesn't show up in GAAP, yet determines whether you can reinvent a product that hadn't changed much since its introduction in 1970, as O'Day says. And then the pandemic hits. Corning endures 6 consecutive quarters of shrinking revenue, its lengthiest drop since the 2001 telecom crash. Here's the fork in the road. Most companies shrink headcount and capacity to match revenue. Corning doesn't. Instead of laying off workers and shrinking factories, it gives employees the option to take some compensation in stock. Weeks says they were probably carrying 4,000 to 5,000 more employees than revenue could support. Corning employs about 56,000 people worldwide. That is a decision that looks reckless if you model the next quarter. And it looks brilliant if you model a decade, because now, with demand for fiber booming, Corning needs all those workers and capacity, and more. This is one of the most important lessons in capital allocation. Capacity decisions are irreversible in the short run. If you cut too deep, you can't regrow expertise quickly. If you protect the core, you can be ready when the cycle turns. Corning protected the core. Now, supply and demand. The article says Corning is the biggest fiber optics maker by a number of measures and has the lion's share of the North American market. Fiber for data centers is the fastest growing part of Corning's revenue. And like many providers to data centers, Corning is already selling all that it can make. A Morningstar analyst, William Kerwin, says the level Corning stock is at is baking in everything going right and nothing going wrong. He also says demand for Corning's fiber is likely to be above supply for the foreseeable future, and if they could produce more, they could ship more. That's the dream and the risk. The dream, you are sold out. The risk, your valuation starts assuming you will remain sold out. And the article adds a constraint that matters. Fiber optic installation is facing a labor shortage. So even if Corning can make the product, the ecosystem has to install it. That's another classic compounding choke point. Complements. Now, bring the deal into view. Corning stock is hovering around its all-time high, boosted by a recently announced $6 billion deal with Meta to supply fiber optic cable for Meta's rapidly growing array of AI data centers. Corning says it is in talks with others for more such deals, and it's working on what could be its next big act. Fiber that goes inside servers, not just connecting servers to each other. That's an important strategic climb, from long-haul connections to dense internal networks inside data centers, enough to soon surpass the long-haul business in miles delivered, O'Day says. And then the next step, fiber inside computers. That's where the relationship with NVIDIA comes in. The article says NVIDIA is exploring servers that directly incorporate Corning's co-packaged optics. Co-packaged optics. That phrase is the sound of the frontier. It implies the optics move closer to the compute, tighter integration, lower latency, lower energy. But it also implies something else: patience and capital. Weeks says the development of co-packaged optics requires both, just like Corning's past innovations. And he drops a human detail. He hasn't been invited to NVIDIA CEO Jensen Huang's famous fried chicken and beer summits yet. Once we actually deliver, Weeks says, I guess that's when you get invited to beer and chicken. That's funny, but it's also the truth of supplier relationships at the cutting edge. You don't get the deepest partnership because you have a PowerPoint. You get it because you ship. Now, I want to align with the visuals on screen, because this article is visually rich, and the viewer will be seeing it. On screen, you're seeing spools of fiber optic thread at a Corning factory in Midland, North Carolina. They're color-coded to make it easier to splice once bundled into cables. And you're seeing manufacturing stages, inspection, stretching, ultra-transparent glass. This is not a commodity vibe, this is craft scaled. And the narration needs to make you feel what that means. You're pulling glass strands as thin as a human hair, yet upward of 30 miles long. The article uses a metaphor so extreme it forces you to picture transparency. If you filled an ocean with them, you could see straight to the bottom. That's the physical reality behind the revenue line. Now, the uncomfortable truths. The reality check. First, Corning's good fortune is contingent on big tech continuing to build at the rates they've indicated. That means Corning is, in part, a pick-and-shovel play on AI CapEx. Second, Corning is already selling all it can make, so growth is constrained by capacity expansion and the broader labor shortage for installation. Third, valuation. When an analyst says the stock price is baking and everything going right, that's a reminder that a great business can still be a dangerous stock at the wrong price. Great business. Different question. Great entry point. So what do we learn timelessly from Corning's story? Lesson 1. The ability to lose money for decades can be a competitive advantage if you are buying learning that eventually becomes scarce. Corning didn't lose money to subsidize customers forever. It lost money to build a capability the world would one day need. Lesson 2. Culture can be an invisible moat when it preserves expertise through cycles. Reassigning engineers instead of laying them off is not altruism. It's an investment in tacit knowledge, the kind you can't replace with hiring sprees. Lesson 3. In hard tech manufacturing, owning the machine that makes the product can matter as much as owning the product design. If you design the manufacturing equipment, you compress iteration cycles and protect process advantage. And now the ending. The core question this article raises is simple. What kind of company can afford to be early and stay early long enough without breaking? Corning's answer is the Corning way: self-contained operations, patient capital, and a workforce built to accumulate expertise across decades. And here's the sentence I want you to remember for years. The biggest compounding isn't in the quarterly numbers. It's in the decades you're willing to look stupid before the world finally agrees you were right. Moving to next title, she got the world hooked on dirty soda. $1 for any size. That's not a price. That's a weapon. That's a founder's wedge into a routine. And that's where this story begins. In the Wall Street Journal, inside St. George, Utah, with a mother of 5 who didn't know she was inventing a category. Nicole Tanner didn't set out to build a national chain. She set out to solve a craving. She was craving caffeine, tired of watered-down fountain soda, and she wanted something fun to drink. Coffee wasn't a choice. She's Mormon, and adherents traditionally abstain. So she does what founders do. She looks at a constraint and treats it like a design brief. No coffee. Okay, then what? Super cold soda with a twist. Lime, fruit, purees. And here's the part that matters for investors. She didn't start by building a brand. She started by building a system that could deliver one specific outcome again and again. A drink that hits the reward circuitry harder than the alternatives, delivered through a drive-through so convenient it becomes a reflex. Now let's talk about the central figure. Nicole Tanner is not just the founder. In this story, she's also the first product manager, the first marketer, the first operator, and the first person to learn, painfully, what she doesn't know. She and her husband used savings to avoid taking out a business loan to buy a 700-square-foot commercial building in St. George, with a big parking lot. That detail is everything. Not the square footage, the parking lot. This is a drive-through business disguised as a soda business. Drive-through is throughput. Drive-through is habit. Drive-through is unit economics you can scale if you can standardize the workflow. And in the beginning, it was the opposite of standardized. It was sticky notes and a Casio register. Cars lined up, employees walked from customer to customer, scribbling orders, ringing up sales. This is what founders do in the early days. Manual labor to validate demand. Not because it's efficient, because it's the fastest way to find truth. Now, go one layer deeper. Suppliers. Tanner initially leased a fountain machine from Coca-Cola. Then she asked PepsiCo for the same and got a pass, because soda rivals typically push restaurant chains to stock their products exclusively. So she does something that sounds small, but it reveals temperament. She buys 2-liter bottles of Pepsi and Mountain Dew from grocery stores. That's not scalable, but it's a refusal to accept no as a permanent state. And after about a month, Pepsi relents, she says. That's negotiation leverage created by demand. Demand is the ultimate bargaining chip. Now let's get to the inflection point. The moment the product becomes a category, customers started referring to Swig's Dr. Pepper and cream combination as dirty soda. And Nicole Tanner latches onto the phrase. She encourages customers to make it dirty when ordering. That's a founder's instinct for language, because language creates a menu that lives in people's heads. Dirty soda is not a SKU, it's permission. It's a cultural shortcut. It's a way for customers to feel like insiders when they order. And once you've got that, you don't just sell drinks, you sell identity. Now, the article makes it clear that the early menu expansion didn't come from a corporate innovation lab. It came from the floor. Swig's regulars included its own young employees, experimenting with ice cream toppings like frozen strawberries and mangoes, expanding the menu options by the hundreds. That's a chaotic innovation engine. It's also dangerous, because every new option is complexity. Complexity slows service. Complexity increases training time. Complexity kills margins if you let it. But in the early phase, you often accept complexity because it reveals what customers actually want. Now, the decision autopsy. What worked and what quietly stopped working? By 2017, Swig had grown to more than a dozen stores. The staff was spread thin. Tanner realized she lacked the expertise to grow further. This is a critical founder moment. The best founders don't cling to control as the business changes shape. They ask, what does the business need now? And here the answer is professionalization. In the article, Andrew Smith, a Utah-based investor whose Savory Fund invests in food and beverage companies, describes Swig as being held together with duct tape and hairpins. Savory Fund takes a majority stake, and Smith takes a board seat. That is capital allocation through governance. It's the founder trading control for competence and scalability. Then another institutional layer arrives. Larry H. Miller Co., a family investment office, brings in a professional chief executive who has taken other companies public, and he is talking of an eventual initial public offering. The chain had around $100 million in sales last year. So the company's arc is clear, from founder-operated to institutionally scaled, with IPO language entering the room. And notice what Tanner does after that shift. She now spends her time on new drinks and store openings. In other words, she stays close to product and expansion, the founder's edge, while others build the machine. Now, distribution. This story is not only about soda, it's about modern media as a growth lever. Swig gets a boost from the cast of The Secret Lives of Mormon Wives, a reality TV show about Utah-based TikTok influencers. And the business took off a few years ago when Olivia Rodrigo was in Utah filming High School Musical and posted an Instagram photo holding a Swig cup. Now, #dirty soda is a hashtag. That's the flywheel. Product turns into content, content turns into customers, customers turn into more content. A physical retail chain borrowing the distribution mechanics of the internet. Now you know you've created a category when the giants copy it. The article says big chains want in. McDonald's recently tested Sprite with lemon vanilla syrup and dragon fruit. Taco Bell swirls a teal-colored Baja Dream Freeze with vanilla cream and calls it a Mountain Dew Baja Blast Dirty Freeze. TGI Fridays started offering dirty sodas that can be boosted with shots of Jack Daniels or Hennessy. And Sonic encouraged customers to make it dirty by ordering creamer and mix-ins. That's the market validating the concept. But it's also competition arriving with scale, which means the moat can't just be, we had the idea first. The moat has to become operations, brand loyalty, locations, and speed. So what does Swig's footprint look like now? The article says Swig has expanded to around 140 locations across 16 states. And it gives a product anchor. The kind of detail that matters because it's what customers repeat. The popular founder drink, named for and created by Tanner, is Diet Coke mixed with sugar-free coconut syrup, lime, and coconut cream. That's a signature, a repeatable ritual, something a customer can order without thinking. Now let's align to what's on screen. On screen, viewers are seeing a photo of Nicole Tanner pouring soda into a clear plastic cup, stuffed with pebble ice. That visual matters because it explains the product without words: cold, fast, tactile, indulgent. They're also seeing an Instagram-style image reference to Olivia Rodrigo's post, which is a reminder that the distribution channel isn't a billboard, it's a feed. And they're seeing the broader framing. This is a Soda Shack chain expanding, with big chains experimenting in the category. Now, reality check. Not everything compounding is clean. The article is explicit. Other soda shack chains like Fee's Drinks and Sodalicious have popped up, creating competition. The high sugar load attracts critics. Some ideas fizzled. Tanner learned the brand doesn't work in malls, and it should focus on its core beverages, not coffee, smoothies, and shaved ice. And a subtle but important operational mistake shows up. Swig trademarked Dirty Soda in 2015, but it lapsed in 2002 because the renewal notice came during the depths of the pandemic, and Swig missed it. Tanner says, "That's what growth does. Growth makes you miss small things that become big later, and it's a reminder that systems, not inspiration, protect compounding." Finally, the story ends in a very founder way, selling the product in person to the people who control capital. At a restaurant finance conference in Las Vegas a few months ago, Swig set up a table of samples, pushed bankers and operators to try drinks like a Texas Tab and a Hula Girl, and the company estimated it served 2,000 drinks. That is distribution again. But this time, it's distribution aimed at expansion capital. Because if you want to scale a chain, you don't just need customers. You need believers with checkbooks. Tanner says they're in extreme high-growth mode right now. So what are the timeless lessons here? Lesson 1. A simple wedge, like $1 for any size, can create a habit that outlives the promotion if the experience is repeatable. Lesson 2. Naming is a compounding asset. Dirty soda became a category because it gave customers a script, and scripts spread. Lesson 3. The founder's job changes as the company scales. First you do everything, then you admit what you can't do, then you trade control for capability, and you focus your time where your edge still compounds. And I'll end with the sentence I want you to remember. The businesses that scale aren't the ones with the best ideas. They're the ones that turn a craving into a repeatable ritual, and a ritual into a machine. Moving to next title, here's where AI is tearing through corporate America. That sentence travels fast because it feels clean. It feels like a one-line prophecy you can trade on. And then reality does what it always does. It gets messy, it gets slow, and it forces you to separate the parts of a story that are true from the parts that are just emotionally satisfying. This part of the Wall Street Journal piece is basically the market sobering up in real time. The sell-off happened, the fear happened, the vibe code will replace everything narrative showed up. And then the adults, operators, procurement people, executives who sign off on liability, started asking the only question that matters in mission-critical systems. What happens when it's wrong? Because in enterprise software, the killer feature isn't novelty. It's reliability. And reliability is the hardest thing to automate. So, the apocalypticism gets met with skepticism. Not because AI isn't powerful, because the incentives of real businesses don't reward clever. They reward works every time. The article says, while few dispute AI's potential to remake business software and virtually every facet of the economy, most believe the impacts will be more diffuse and delayed than the sell-off suggested. That's the first key idea. Diffuse. Delayed. Not nothing, just not instant replacement. Now, the central figures. You've got Alphabet CEO Sundar Pichai telling people not to write eulogies, saying the companies seizing the moment have the same opportunity ahead. That's a CEO speaking like an ecosystem steward. We're all early, don't declare winners and losers too soon. Then you've got NVIDIA CEO Jensen Huang at a conference in San Francisco calling it the most illogical thing in the world to say the software industry is in decline and will be replaced by AI. And he gives a metaphor that's pure operator logic. If you were a humanoid robot, would you use a screwdriver or invent a new screwdriver? In other words, tools get better. They don't disappear. And then you've got the finance side echoing the same skepticism. JP Morgan analyst Mark Murphy calls it illogical to expect every company to write and maintain bespoke software to replace every layer of mission-critical enterprise software they've ever deployed. This is the narrative maturing. From AI writes code, therefore SaaS is doomed, to AI writes code, therefore the economics of some software categories will change. Those are different claims. One is a headline. The other is investable. Now, the article gives you practical evidence that companies are adopting AI, but not blindly. Pandora uses Claude Code for some coding issues, and AI agents handle 60% of customer interactions. 60%. That's big. That's not a pilot. That's a real operational shift. But then Pandora's chief digital and technology officer, David Walmsley, draws a line. He's less willing to experiment in critical functions like human resources. And he says it flatly, "I'm not going to industrialize my world around a bunch of vibe code." That's a boundary, and boundaries are where business models survive. AI can help you where mistakes are cheap or reversible. AI gets throttled where mistakes are expensive, regulated, or reputationally fatal. Now we go into disaster potential, and this is where procurement logic becomes investing logic. At Authentic Brands, the company we heard about earlier, an in-house tool powered by models from OpenAI, Anthropic, Google, and others, helps marketers generate mock-ups of ads and helps financial analysts vet licensing agreements. It can shave weeks off many projects, says Adam Cronengold. That's an ROI story. Time saved, cycle time compressed. But the article contrasts that with healthcare, where replacing tested solutions with hacked-together systems carries massive disaster potential. And then we get one of the best lines in the whole piece from Satish Ravala, CTO of Candescent, which makes digital tech used by banks and credit unions. Banks rely on software that does exactly what it's supposed to every time, something AI struggles with. And he makes it painfully concrete. If I want to transfer $10, it better be $10, not $9.99. That's what enterprise buyers are really buying. Not UI, not features. Certainty. Now, the capital allocation lens. Anish Acharya of Andreessen Horowitz says software costs are only about 8% to 10% of enterprise spending. That's a small portion. So even if vibe coding saves a fraction of that, for most companies it isn't worth the legal and compliance risks. This is a crucial inversion. The internet assumes companies optimize for cost. Regulated industries often optimize for liability, and liability reshapes the adoption curve. Now, one of my favorite points in this section is subtle and devastating for the SaaS gets eaten narrative. Aaron Levy, CEO of Box, points out that OpenAI and Anthropic are themselves customers of numerous large software-as-a-service platforms. That's the tell. Even the AI companies don't run their businesses on vibes alone. And Levy predicts a flourishing of new custom software that works with existing platforms. He gives an example. If you have a Claude agent review a contract, you still need a place to manage the contracts. Mark Smith of ISG says exactly that. Leverage in contract renewals. And added pressure on vendors could drive a wave of merger and acquisition activity. That's how the industry adapts. Not by dying, by consolidating, by bundling, by raising switching costs. By buying distribution. Then we get the line that, to me, is the correct conclusion for this whole episode. Ravala says, software is not dead. The dumb software is dead, or will be at some point. That is the real filter. Not software versus AI, but dumb versus defensible. So what do the visuals show? On screen, you're looking at a chart labeled Key Software Companies, Share Price versus Index Performance Past 6 months, with names like Salesforce, Workday, ServiceNow, Intuit, and Monday.com plotted against the S&P 500. The point of the chart isn't the exact squiggles. It's the dispersion. It's the message. The market is punishing parts of software hard relative to the index. And what most people miss is that this kind of chart is not only about earnings. It's about narrative risk premium. When the market can't model the future clearly, it demands a higher return. So it marks prices down. Now, reality check. The article is telling you that incumbents can survive and even thrive, especially those that adjust their business models to meet the moment. And that's the investing task. Identify which vendors have proprietary data, deep domain expertise, and products that are deeply entangled in tech stacks, because those are hard to rip out. Also, identify which categories are dumb software, thin wrappers around workflows that can be replicated by agents. Now, 3 lessons. Lesson 1, adoption follows liability, not hype. Where mistakes are cheap, AI will move fast. Where mistakes are catastrophic, incumbents buy time. Lesson 2, systems of record are not easily displaced. Agents can create work, but someone still has to own the ledger. Contracts, payments, compliance, identity, audit. Lesson 3. When options explode, bargaining power shifts to buyers. That doesn't kill vendors automatically, but it compresses pricing power and forces consolidation. And I'll end with one sentence worth keeping. AI won't delete software. It will expose which software was never earning its keep. Moving to next title, SpaceX delays Mars plans, eyes Moon. SpaceX is putting off Mars, not because Mars stopped mattering, because Mars started competing with something more immediate, more contractual, and more unforgiving: the Moon. This is the Wall Street Journal story in one sentence. A company built on audacity is doing something that, in the long run, might be its most mature move yet: reprioritizing. And if you're a value investor, you should lean forward here, because reprioritization is where real capital allocation reveals itself. Founders talk about everything. Allocators choose. SpaceX has put off a mission to Mars planned for this year, shifting its focus to a long-promised lunar voyage for NASA. The company told investors it will prioritize going to the Moon first and attempt a trip to Mars later, according to people familiar with the matter. And then we get a detail that turns the story from vision into schedule. SpaceX will target March 2027 for a lunar landing without humans on board, another person said. March 2027. That's not a dream. That's a deliverable. A date that implies milestones, manufacturing cadence, test cadence, launch cadence, and one of the most difficult operational feats the company has ever had to demonstrate at scale: refueling in orbit. Now, the central figure. Elon Musk sits at the center of this like a human capital stack. He's SpaceX's CEO. He's also the person who can bend narrative, recruit talent, and push organizations into impossible timelines. But the real question is always the same. Is the narrative serving the strategy, or is the strategy being sacrificed to the narrative? This article suggests something important. The strategy is asserting itself, because the strategic shift comes as SpaceX doubles down on plans to launch artificial intelligence data centers in space after acquiring Musk's startup xAI. That deal, announced Monday, gives the combined company a valuation of $1.25 trillion. And SpaceX also plans to go public in an IPO that could come as soon as summer, so you can feel the new capital logic forming. SpaceX isn't only a rocket company in this framing. It's positioning itself as an infrastructure company, one that wants to turn space into a platform for compute. And compute in this era is one of the few markets hungry enough to fund absurd capex if you can plausibly promise defensible advantage. Now, let's do the inflection point. NASA hired SpaceX a few years ago to prepare a version of Starship to meet an agency spacecraft near the Moon, take on a crew, and transport U.S. astronauts down to the lunar surface. Landing astronauts there is a key part of NASA's Artemis program, and SpaceX has used billions of dollars in NASA funding to help develop Starship, a more than 400-foot-tall rocket designed to be fully reusable. That's the economic core. NASA as the anchor customer financing the development of the machine. Now place that next to Musk's public stance. Last year, Musk called the Moon a distraction and said SpaceX is going straight to Mars. So what changed? Pressure. The article says agency officials put pressure on SpaceX last year, calling on the company to prioritize the Moon. And since then, SpaceX has pitched NASA what it called a simplified path back to taking crews down to the Moon. This is the allocator meeting the counterparty. When your largest customer is also your regulator, your partner, and your funder, you don't get to ignore the direction of their priorities. You can negotiate, you can reframe, but you can't pretend. Now, the decision autopsy. What was expected? SpaceX previously said it planned to launch 5 Starships to Mars in late 2026, taking advantage of a window when Earth and Mars are closer, making the voyage easier. What actually happened? They're shifting focus to the Moon first. Mars gets pushed out. And the article gives you a hint that even the Mars this year idea was already weakening. In a podcast interview aired in January, Musk played down prospects of getting to Mars this year, saying they could, but it would be low probability and somewhat of a distraction. That's the founder admitting, carefully, that the plan isn't aligned with the bottleneck. Now, the bottleneck. The company will be hard-pressed to meet the March 2027 schedule. Why? Because doing so will require SpaceX to frequently launch Starship and show it can refuel the vehicle while in orbit. This is the hidden cost of ambition. Proof, not talk. Proof. Orbit refueling is not a marketing milestone. It's a systems engineering milestone, and it's a reliability milestone, because you don't get reusable until you can repeat, and you don't get repeat until you can refuel, turn around, and launch again and again without fragile heroics. Now, the part that makes this feel like a modern conglomerate story instead of a pure aerospace story: xAI. In a memo announcing the merger, Musk outlines plans to help build a permanent presence on the Moon, and references using it as a base for deeper exploration. And he writes that the capabilities unlocked by making space-based data centers a reality will fund and enable self-growing bases on the Moon, an entire civilization on Mars, and ultimately expansion to the universe. That's the thesis. Compute cash flows, real demand, near-term, fund the long-term civilization projects. So if you're thinking like an investor, you translate it into this. SpaceX is trying to create a flywheel where infrastructure in space enables compute generates capital and strategic relevance, and that capital funds the next infrastructure layer. Moon first, Mars later, infinity eventually. Now, IPO optionality. The article says SpaceX plans to go public in an IPO that could come as soon as summer. That's a major change in implied time horizon. A private company can live with long periods of opacity and patience. A public company is constantly priced by the marginal buyer's mood and the quarter's narrative. So if SpaceX is truly moving toward an IPO, the capital allocation discipline becomes more important, not less, because public markets forgive ambition less than they forgive delivery. And delivery is exactly what this moon pivot is trying to prioritize. Now, I want to confront the uncomfortable truth this article reveals. SpaceX is not choosing between Moon and Mars as destinations. It's choosing between two kinds of constraints. Mars is a visionary constraint. Launch windows, distance, and the future. The Moon is a contractual constraint. NASA timelines, Artemis milestones, and political visibility. And the Moon is also a technical constraint. Refueling, cadence, reliability, compressed into a nearer time frame. When you're building a compounding machine, you don't chase the farthest horizon first. You secure the next rung that unlocks more capability. That is how compounding works in business and in engineering. So here are the lessons. Lesson 1. Incentives beat ambition. NASA's pressure and funding structure shape SpaceX's priorities no matter what the founder says on a stage. Lesson 2. The bottleneck defines the schedule. March 2027 is not about desire, it's about proving frequent launches and orbital refueling. Lesson 3. Optionality is a form of power. An IPO, as soon as summer, and a $1.25 trillion valuation after the xAI acquisition are signals that SpaceX is positioning itself to access a broader pool of capital that can fund the next decade of build-out if the company can keep delivering. And I'll end with one sentence worth remembering for years. In frontier businesses, the destination is marketing, but the next milestone is survival. Now, towards last article, organic baby food brand jumps in NYSE debut. A baby food company chose to go public at the exact moment America started interrogating what's inside the food. That's the opening move. That's the bet. And the Wall Street Journal frames it plainly. Once Upon a Farm is betting the MAHA era is its moment. The maker of organic children's food debuts on the New York Stock Exchange on a Friday when food is under scrutiny by consumers and by government officials. And right there, before you even get to revenue or margins, you get the real investing question. Is this a company riding a wave, or is it a company built for the wave? Because those are different things. Waves lift everything. But only certain businesses can survive the undertow of regulation, ingredient inflation, supply chain complexity, and the brutal honesty of parents buying food for their kids. Now, what does Once Upon a Farm actually sell? The article gives a clean list, and that list matters because it defines the brand boundary: pouches, oat bars, frozen meals, pantry snacks, and the defining negative space: made without added sugar, preservatives, or artificial ingredients. That's not just a marketing line. That is a constraint that forces a different operating model. When you remove preservatives and artificial ingredients, you don't get the same shelf life. You don't get the same distribution ease. You inherit a harder job. And in business, harder jobs can be moats if you get the system right, because not everyone wants to do hard. Now, central figures. The company is co-founded by veteran food executive John Foraker and actress Jennifer Garner. This pairing is not accidental. It's operator plus distribution. It's someone who knows how to build, source, and scale food, and someone who can make the brand feel human and trusted to the exact buyer you need: Millennial and Gen Z parents. And the article even names the persona. Garner is not just a celebrity co-founder. She's Farmer Jen. That's the brand's attempt to convert fame into familiarity, and familiarity into trust. Now, the inflection point. The piece says, U.S. consumers are more focused than ever on health and wellness. paying particular attention to ingredients and how foods are made. And then it adds the accelerant. The Trump administration's Make America Healthy Again movement is fueling that focus, sending food companies scrambling to update offerings to satisfy regulators as well as consumers. That sentence is the entire macro. Because when regulators care and consumers care, companies don't get to treat clean label as a niche. It becomes table stakes. And when table stakes change, incumbents with old formulations face real switching costs. New sourcing, new manufacturing processes, different QA, different shelf life dynamics. So Foraker's quote lands differently here. He says consumers increasingly understand the relationship between what they eat and overall health, and the desire for fresher, fair, and clean ingredients has grown more mainstream. He calls it a steady tailwind for years and years, and says there's no question it's blowing stronger now. This is how operators talk. They don't say sudden trend. They say slow shift that finally became undeniable. Now let's do capital allocation, because that's where public market stories get real. The company's shares jumped 17% on the first day after the IPO, priced at $18 a share, in the middle of the expected $17 to $19 range. The article shows it trading around $21.05, a 17% move from the IPO price. And Once Upon a Farm says it raised close to $198 million in the IPO. So what's the money for? The filing says proceeds will be used to repay debts, purchase new equipment, and fund other expenses. That is not glamorous. That is industrial. That is, we need capacity. New equipment is a bet on volume and margin structure, and other expenses is the vague bucket. But in businesses like this, it usually means growth requires working capital, logistics, and distribution investment. Now, the detail that tells you this is not a pure shelf-stable snack story. Refrigeration. Once Upon a Farm got its start in 2015 as a baby food company launched by Cassandra Curtis and Ari Raz. Then, Foraker and Garner joined 2 years later, helping bring to market refrigerated pouches that now compete with Gerber, Go-Go Squeezy, and Stonyfield. Refrigerated pouches. That's a different operational choice. Harder distribution, more constraints, but also differentiation. Freshness can be a positioning wedge if you can put the cooler in the store and keep it stocked. And the article says the Berkeley, California company expanded its product lineup and in recent years installed coolers in grocery stores to meet growing demand for fresh baby food. That is CapEx in the wild. That is physical infrastructure placed right in the retailer's footprint. That is also a quiet signal about bargaining power and execution. You don't install coolers widely unless you believe sell-through will justify the real estate and the hassle. Now, let's talk visuals, because this article is loaded with them, and they matter for the on-screen rule. On screen, viewers see the IPO day chart, an intraday line that starts at the $18 IPO price and rises to about $21.05, with the plus 17% call-out. That's not just celebration, it's market appetite for healthy narratives in the current moment. They also see the NYSE bell photo, Cassandra Curtis, Jennifer Garner, and John Foraker ringing the bell. That image is a triangle of roles: origin founder, celebrity distributor, professional operator. If you're paying attention, that's a governance and incentive story in one frame. Now, reality check. The company's numbers are not hidden. For the 12 months ended September 30th, 2025, it booked net sales of $226 million. It had a net loss of $52 million for the same period. So this is not a profitability story yet. This is a scale and build-out story. And that matters, because clean label businesses often face a tough early trade-off: higher input costs, more complicated logistics, and slower path to margin if you insist on the brand promise. This is where you separate companies that are merely positioned well from companies that can compound. Compounding requires a system that throws off cash eventually. Now we get into incentives, because incentives are where these modern celebrity plus operator companies can go right or go wrong. Garner serves on the board. In her role as co-founder and farmer Jen, she received $1 million in 2000, with $2 million due this year, plus $2 million in 2000, and $3 million in 2008. She also received stock options and is eligible for a cash bonus tied to the public offering price. Foraker earned $3.3 million in total compensation for 2025, according to the filing. What do I take from that? I take the obvious. The company is paying for the two assets it believes matter most: operational expertise and brand trust. But I also take the caution. Tying compensation to IPO price can pull focus toward the event instead of the decade. If you're a long-term investor, you always ask, what incentives remain after the bell ringing? Now, 3 lessons I'd take from this. First, clean ingredients is not a feature, it's a manufacturing and distribution philosophy. If you can build the system, it becomes defensible. If you can't, it becomes a margin trap. Second, the best celebrity partnerships aren't endorsements, they're roles. Farmer Gin is the company trying to turn marketing into a repeatable trust engine, not a one-time spike. Third, going public is not a victory lap, it's a capital allocation decision. Debt repayment and equipment purchases are the company telling you, we're still building the machine. And I'll end with one sentence that I think captures the core question raised by this story. In consumer goods, the brand promise is easy to say. Compounding is proving you can keep it when the scale shows up. This is Avi. Like and subscribe. On to the next.